Well, welcome everyone to today's webinar, and thanks for joining us. And let me also welcome our Mortgage Choice Amplify and Connective Elevate partners. For those that don't know me, my name is Tony MacRae. I am the Chief Commercial Officer for Bluestone, and joining us as always today, we have Tim Lawless from CoreLogic. So Tim and I will talk through some of the hot topics about the current housing market today. And I'm sure we're all looking forward, as always, to hearing Tim's views. So just a couple of logistics. At the conclusion of the presentation, there'll be an opportunity to ask questions. So if you have a question, please just type them into the Q&A section in Zoom. There will also be one CPD point for attending today's session, and a copy of the presentation as well as the webinar recording will be shared out to all of the attendees by email. Now, I say this all the time, but generally mean it. Tim really needs no introduction, but let me just give a brief one. So Tim's widely regarded as one of Australia's leading property market analysts and commentators by both business and the media. He brings more than 20 years experience to the role and provides deep insights and analysis on national housing trends. Tim's expertise across property markets has positioned him as one of the country's most experienced and popular property market analysts and commentators. And as always, it's a pleasure to have Tim on board, and welcome, and thanks for joining us, Tim.
It's always a pleasure, Tony, and looking forward to some good conversation today.
Fantastic. All right, we'll try and change it up a little bit today, and instead of just going straight to presentation, we talk about some of the topics. Obviously, we're here to talk about housing, but it'd be good to just get an initial overview. And I'm always keen, though, so we know the housing market continues to be buoyed. But what we're seeing, is it a level playing field, or have we got different speed housing economies going on out there?
Yeah, I think it's fair to say there's always some diversity beneath the headline numbers. You know, the national trends are one thing, and that's at the moment looking extraordinarily positive and consistently positive. In fact, we've been seeing housing values rising for 16 months straight now, and about to report a 17th straight month when our June data comes out next Monday. So, but yeah, when you look below the surface, absolutely, there is a lot of diversity in the market, and you can put that back to just different demographic trends, taxation environments, levels of affordability, investor appetite, and so forth as well. So if I can drive some of those points home, if I can just share my screen for a moment, and we'll do this a few times through the presentation. I think, Tony, I'll just share some graphs just to illustrate the trends. You can see that at the national level, as I mentioned, we've got this consistent run of growth. 16 months into the growth cycle now, we've seen housing values rise generally about 0.6, 0.7% month on month at the moment. And since the market bottomed out back in January of last year, we've seen a national index increase a little bit more than 12%. In fact, it's pushing to new record highs since November last year, when we posted a nominal recovery. So I'll be the first to say that normally when you have high interest rates, really low levels of consumer sentiment, cost of living pressures, which are quite extreme, and I think you'd probably describe the lending environment as fairly cautious as well. When you look at some of the APRA data on, say, high LVR or high DTI lending and so forth, is generally very low. Yet we're still seeing this upwards trend in housing values, which really comes back to just the undersupply of housing we're seeing in the market, which I'm sure we'll talk about down the track. But to your point, there is a lot of diversity. You can see that at the capital city level. I'm just looking at a quarterly trend here. Like Perth, for example, is just running its own race. We're seeing housing values in that market rising at about $14,000 month on month. In percentage terms, about 2% month on month rise. And rather than showing any signs of slowing down just yet, you can see the trend has actually accelerated a little bit through the first 5 months of 2024. So you've got to remember, Perth is, even though it has seen values rise a little bit more than 20% so far over the past 12 months, it's still a fairly affordable market. It's when you adjust for incomes, Perth is sort of middle to lower end of the pack for housing affordability. And that's probably a key factor in the fact that we haven't seen much of a slowdown, but it also is a market that's quite undersupplied and has very strong demand coming in from both interstate and overseas migration. And then you've got markets like Adelaide and Brisbane, sort of middle of the pack, but still, I mean, looking at a growth rate around 4% quarter on quarter, a little bit more than 1% growth month on month. I mean, these markets are still very strong. Brisbane slowed down a little bit, but you can see there's been a bit of a reacceleration in both Brisbane and Adelaide over the past month or two. And then you've got everywhere else, which is generally a fairly, I guess, sustainable trend. You're seeing quarterly growth rates between sort of 1% down to Melbourne that's roughly flat. Regional markets as well, generally underperforming compared to the capital cities, or at least on par now. A very different trend that we're seeing through the pandemic. But you can drill down a little bit further on these numbers, Tony, and see that, for example, it does seem to be the more affordable end of the market that's really shining through now. You can see that on a stratified hedonic index, where we look at the lower quartile of the market, which is the yellow trend line here, compared to the upper trend line of, the upper quartile, which is the darker trend line. Please try again. Sorry, Siri thought I was talking to it. The lower quartile of the market, I think, is really powering ahead now, simply due to the fact that there's been an erosion of borrowing capacity. Affordability constraints are quite stretched as well, which is probably starting to see demand being deflected towards that middle to lower end of the market. It's not just markets that are more affordable like Perth, Adelaide, Brisbane that are driving this capital city trend. Even in markets like Sydney and Melbourne, it's really clear it's that lower quartile that's seeing a stronger growth trend. Similarly, it's also the unit market that's starting to show a stronger growth trend now as well, which I think, again, would probably be attributable to more affordable price points, but also a pickup in investment activity. First home buyers are overrepresented in the marketplace at the moment as well. And they're probably, generally more cost sensitive as well than subsequent buyers. So overall, I think, yeah, absolutely, there's a real tapestry here in terms of the performance of the market. There isn't just one speed, it's definitely multi-speed. And even from capital city to capital city and regional market to regional market, there's different speeds below those capital city levels as well.
Yeah, you highlighted Melbourne there, and along with Perth, and we were chatting before we went live that your observation that Melbourne had probably done an efficient job of getting supply historically into the market, and that may be driving a slightly more subdued pricing. On the flip side, in those that are going strong, is your observation that it's a demand or supply driven environment that's driving those prices?
It's a combination of both, but I would put most of this strong growth trajectory back to the supply side. You look at the housing supply in a bunch of different ways. There's the number of listings in the marketplace, which are generally very low across most markets, but the softer markets like Melbourne have definitely seen a normalization in available supply. In fact, more than that, we're now seeing listings above average. But then you've also got new housing construction, which, as you say, Tony, Melbourne's been a little bit better in delivering, historically at least, new housing supply to the market, both greenfield, outer fringe detached homes, as well as density around the inner city markets. So in an area like Perth, we've got the supply side is still confined. Well, pretty much everywhere around the country, supply is still quite constrained by capacity constraints, by high construction costs, margin compression for a lot of builders where, trying to get a feasibility together that delivers stock to the marketplace with a reasonable profit margin to it is very hard. Labor is still very, very scarce. as well. So I think, again, there's a real tapestry here of the supply and demand dynamics. The demand side, a lot of people point to the migration trends, which have been extremely strong, a lot of catch up coming through from overseas migration. But remember, when you look at the visa types that comprise overseas migration to Australia, about 90% of this overseas migration are non-permanent migrants. They're generally students or temporary migrants that typically wouldn't be purchasing. There is going to be an element of temporary visas that can purchase established homes at least, as well as new homes. But most of the demand from overseas migration is going to be flowing into rental demand at a time when rental markets are very tight as well. So yeah, I think again, I'll share my screen here just to drive some of these points forward about the supply demand dynamics. So I mentioned listings being very low. You can see that in these graphs here, right? Even though we're seeing vendors are more active than normal than what you would have seen, say, last year at this time or against the 5-year average, you can see that on the left-hand side graph where that black incomplete trend line, which is the year to date for 2024, is higher than the dotted trend line, which is the 5-year average, or the yellow trend line, which is a year ago. This tells us that vendors are no longer sitting on their hands. People are selling their homes. But that supply that's coming into the market, that newly listed supply, is being absorbed pretty quickly. You can see that in the graph on the right, which is total listings in the market are roughly on par with what they were a year ago, but still 16% below normal for this time of the year based on that previous 5-year average. But again, when you start to look at some of the capital cities, look at somewhere like Melbourne, for example, and you can see that yellow trend line is now well above the 5-year average. It's about 13% above average. It's nearly 17% above where it was a year ago. It just highlights that Melbourne now has more stock to choose from. Buyers have more choice. They can negotiate a little bit harder. And if they don't get the price that's right, they can move on to the next property. Whereas go to somewhere like Perth, listings in Perth are still more than 45% below average for this time of the year. Adelaide and Brisbane, you can see, are also quite constrained from a supply perspective. Sydney's, roughly on par with a year ago, but still a bit below average. And of course, Sydney is still seeing housing prices rising. Hobart's been high for quite some time. So when you look at the balance of all these indicators, this graph really sums it up. So what we're looking at here is on the vertical axis is the number of listings in the market compared to the 5-year average. So if you're in the top left-hand corner of this graph, you've generally got high supply, at least high effective supply. If you're down the bottom right-hand corner, you've got very low supply relative to the 5-year average. And of course, the horizontal trend line looks at growth, just the monthly rate of growth over the past 4 weeks. And it's probably unsurprising. Those markets with lower supply levels are generally seeing a stronger growth dynamic in the marketplace. And this is playing out across demand that's generally at about average levels. Remember, demand, at least based on demonstrated demand, based on the number of home sales, I wouldn't say it's shooting the lights out. Remember, there's affordability constraints, there's a fairly cautious lending environment, there's low sentiment. All these factors are probably keeping a lid on transactional activity to some extent, but we are seeing demand at above average levels or transactional activity at above average levels at a time when available supply is below average levels. And it's that disconnect that's really driving upwards pressure on housing prices. The fact that the rate of absorption in the market is outpacing the rate of addition of new listings coming into the market. Of course, Economics 101, that's really what's pushing up housing prices. Until we see a more substantial supply response coming into the market, we probably will continue to see this upwards pressure and a lot of, differences from city to city, like Melbourne, for example, where we have seen a rebalancing in available supply.
A question from the audience, Tim, again relating to Melbourne. How much do you put Victoria's new property tax regime down to more properties hitting the market and greater supply there?
Yeah, I think that's probably a component. Well, probably is a loose word there. Absolutely, it's a factor. So for a bit of context, of course, we did see in the Vic budget, land tax thresholds have been reduced substantially, meaning a lot more people are paying land tax. And for, say, multiple investment property owners, they're probably paying a lot more in dollar terms as well. And add that to higher stamp duties, windfall taxes, vacancy tax for air or short-term stays, are all, add them all up together. There's clearly some greener pastures outside of Victoria, not just from a taxation environment, but also I think a lot of investors will be looking at the stronger rates of capital gain in markets like WA, in Queensland, higher rental returns as well, and maybe a medium term at least prospect for future capital gains being stronger outside of Victoria. The flip side, of course, is Melbourne is really building up a competitive advantage now in some ways. It's the one major capital city where affordability is actually improving. We're definitely seeing rental yields on an upwards trajectory now because rents are rising at a time when values are pretty flat. So maybe cast forward another 5 years and this competitive advantage may really shine through for Victoria as being a healthier market or a better market for investment returns as well. But yeah, I think at the time being, there's definitely markets that are probably looking a little bit better for investment. But it's great to see affordability improving in that marketplace.
Just on the demand side, you and I have previously spoken about, migration obviously plays a role in the demand, but observations have been migrants will typically rent for a couple of years before they buy. Have you seen a shift in that, and that's playing people are buying earlier in their journey, and that's driving up some demand?
Yeah, well, we're definitely seeing a shift in the demographic trends, Tony, and anecdotally, I think there is evidence that we are seeing some spillover from rental demand into purchasing demand. So the change in the demographic trends is clearly that net overseas migration has peaked. That was back in the March quarter of 2023. We saw net overseas migration peaked, fell away through June, bounced back a bit through September, then fell pretty sharply through the December quarter. Part of that's seasonal, part of it's just the catch-up has played out for overseas migration. There's a lot of students and migrants came back after borders were closed. So I think as we see net overseas migration normalizing, and of course there's a lot of probably political tension around that previously very high rate of migration as well, driving housing demand and particularly rental demand. I think that will gradually flow through to a much more normal rental trend. But we still have the lagging effect of, as you said, Tony, for permanent migrants, there's generally about a 3 to 5 year lag in them purchasing homes. But I think given the fact that rental markets have been so tight, we're still seeing vacancy rates generally around 1%, maybe a bit lower than that in some markets. There probably does have this, I guess, this expedited flow of purchasing activity, or even for renters who are looking to get into the marketplace, maybe fast tracking the decisions simply to get out of the rental cycle where we are still seeing a lot of upwards pressure on rents. So if you're a renter and have the financial ability to do so, to buy, you're probably going to jump at the chance, partly because you're probably sick of the uncertainty around rental tenure, but also there are quite a few incentives out there for first home buyers as well, when you can accrue the grants or some of the stimulus like deposit guarantees and shared equity and so forth as well. There are a few legs up available at the moment.
So if we just shift lens to the lending space there, style of borrowers that are dominating the market at the moment, have you seen a shift, from owner occupied to investors or first home buyers or refinancers? Anything really happening in the market there?
Yeah, absolutely. I think there's a fairly clear shift where investors are becoming more active. And in fact, investors comprise roughly about 37% of mortgage demand at the moment, up from the long-term average, which is generally about a third. So again, let me just share my screen here, Tony. This is the investor trends, right? I'm just looking at the proportion of loans for investment purposes, well, again, as a proportion of all lending. So investors, about 37% of mortgage demand. Go back to sort of the onset of the pandemic, we're seeing investors at about 22% of mortgage demand. So it's a pretty big step up. And you can see there was a little bit of weakness in investment activity coming in through the early part of the rate hiking cycle, and some uncertainty around, just as an example, Queensland, for example, announced kind of similar to Victoria, changes in land tax that never actually went ahead, but certainly did cause some disruption of confidence. A lot of that seems to have passed now, and we're certainly seeing investors positioning in the marketplace. We're also seeing first home buyers becoming more active as well. If you look at the trend in first home buyers, they're now overrepresented. So normally you'd expect, at least on the long run average, first home buyers to be about 25% of owner-occupier demand. They're now at about 29%. So it is kind of counterintuitive when you think that affordability constraints are quite high. Trying to save for a deposit's become more challenging during a cost of living crisis, and with rents going up so quickly, sentiment's low, and lenders are generally pretty cautious around high LVR lending as well. So to see first home buyers quite active, I think is probably a reflection of just such tight rental conditions, as well as some of those incentives in the market. And maybe under the headlines here or below the radar would be also a little bit of intergenerational wealth transfer is probably at play. The bank of mum and dad, if you're lucky enough to have a benefactor like that helping you out with your deposit or acting as a guarantor, for example. I mean, a lot of more mature homeowners would have a lot of equity behind them. Housing values nationally since the onset of the pandemic, so just the last 4 and a bit years, are up about 30, 32, 33%. So there's probably a lot of equity being unleashed as well. And maybe that helps to explain the fact that subsequent buyers haven't seen quite as much growth as well. There probably is some, downsizing or reduction of debt and utilizing, cashing out of the market and utilizing some of that profitability to de-risk at the household level. We can certainly see some of that data from the likes of PEXA, for example, that have seen a rise in the proportion of properties transacting for cash as well. So that probably helps to explain it. And of course, on the refi trend, refi is now normalizing. We've been through this period of extreme refinancing as a lot of people who locked into fixed rate loans through the pandemic, the fixed rate cliff, as people were talking about it, that peaked in about June or July of last year, when a little bit more than 45% of all finance activity was refinancing across all external refinancing across the mortgage book. Now it's about 36%, not far off the long run average. It'll probably continue and level out around that long-term average quite shortly, now that we're getting through the bulk of that that surge in refi activity associated with fixed rate lending, sort of between mid 2020s and mid 2022.
It's probably not surprising in the graphs there that the more expensive states are being dominated by investor, and the more affordable are seeing a pickup in first home buyers. Fair comment?
Yeah, absolutely. And like I said, Victoria is a good example of that. Not much a 30% investment activity in Victoria is still pretty decent, but nowhere near what we're seeing in say, WA or New South Wales even, which is quite an expensive market. But first home buyer activity is elevated across Victoria, which again probably speaks to some of the affordability improvements in the marketplace, and of course the concessions for stamp duty. So yeah, quite different when you look at it state to state, and the different types of buyers that are active or inactive.
And just a couple of questions from the audience. One is, are you seeing a differential between the capitals and regional areas? And has that shifted since COVID? We had more and more people making those tree change moves.
There's been some pretty big shifts regionally, both during COVID and now what you might describe as living with COVID. So throughout the pandemic, you can probably all remember, there's a real demographic shift that favored regional markets, where a lot more people were leaving the capitals to go to regional markets, and fewer people were leaving regional Australia to come back to the capitals. And that resulted in a real demand surge at a time when there wasn't really any supply response. So through the pandemic, absolutely, we did see regional markets much stronger than their capital city counterparts. And that growth trend lasted a bit longer as well. It was more sustained. So as the capital city trend started to ease off amid the rate hiking cycle or affordability pressures, regional markets kept going for a bit longer. But since about early 2023, as we've moved into this new growth cycle, it's generally been characterized by a normalization in regional demographic trends. So we're now seeing regional population growth. It's only a little bit higher than pre-COVID levels. I think that probably speaks to some of the restructuring we've seen in where people are prepared to live. If you can base yourself in a regional market that's still commutable back into a major working node or a major city, then you may have a lifestyle dividend. It may be a little bit more affordable as long as you have a good commutability. But nowhere near the same sort of levels of growth as what we're seeing through the pandemic. The recent trend, though, has been a bit of a slowdown in the pace of growth in the capital cities, whereas regional markets have held pretty firm. So once again, a bit of a convergence in the growth trends. My gut feel is probably those regional markets that have that mix of commutability and livability, and to a lesser extent affordability, are probably going to be the ones that show a stronger performance. So by that, it would be areas like, the Sunshine Coast and the Gold Coast, either side of Brisbane and Toowoomba, Newcastle, Wollongong, the Blue Mountains, either side of Sydney. Longer term, you'd have to expect something similar in Geelong, maybe Ballarat in Melbourne, although those regional markets, particularly Ballarat, are still quite soft around Victoria, in line with the broader state performance.
Thanks for that. So I sort of shift just slightly again. There's clearly a cost of living issue going on throughout Australia at the moment. How are you seeing that translate into loan book performance, and do you expect that to start to bite on property prices at any point in time?
Yeah, I mean, we're definitely seeing mortgage arrears rising, and that's unsurprising. Mortgage arrears are rising from a fairly low base, and I'd attribute that to a combination of a lot of the forbearance that we're seeing through the pandemic is no longer available, and banks, I think, were quite flexible and generous through the pandemic, working with borrowers during periods of uncertainty. So that's obviously wearing off. But we're also in, as you say, Tony, a cost of living crisis. It's a lot harder to make ends meet when you have non-discretionary goods like fuel, insurances, food, those sort of things really driving the higher inflation numbers. And then, of course, you've got a loosening labor market, fairly weak economy as well. So if I show you the trend in mortgage arrears, you can see quite clearly is rising. So overall arrears, which includes 90 plus as well as 30 to 89 day arrears, sitting at about 1.6%, up from 1% through that sort of bottomed out here in 2022. So if you consider maybe the pre-COVID number as maybe normal, that was at a 1.8% arrears rate. So we're not quite there yet. We're still seeing mortgage arrears that are below the pre-COVID levels, but 90-day arrears are roughly in line now with pre-COVID times. And each of those underlying metrics, the 90 plus and 30 to 89-day arrears, are now just slightly above the 5-year average as well. And I think we'd be naive to think arrears won't rise further from here. But given all these downside pressures around affordability, cost of living pressures, loosening labor markets, all that, arrears have been really contained. And I think that really speaks to the savings buffers that were built up through the pandemic, which are now being drawn down. The fact that we're seeing a record number of workers working multiple jobs. So if you look at the multiple jobs indicator, it's at about 6.7% of all workers have more than one job. That's a record. And we're also seeing, households pulling back on their spending as much as they can. You can see that in the retail figures, but clearly there's things that households can't pull back on, like insurances, healthcare, education, fuel, all those sort of things, which we know are the sticky component of inflation. And that last mile of inflation, as they call it, is clearly still going to be quite a challenge, and what the Reserve Bank is still quite cautious about.
And do you see a point in time where that is going to negatively impact housing prices? Are we near it, or there's still some time to go?
I don't think mortgage arrears are going to have a big impact on housing prices. I guess what you mean is, will we see a material lift in, say, forced sales or distressed sales or motivated selling? Well, there probably is a lift in that those type of listings coming into the market, but again, from very low levels, and it is a hard thing to measure. I think the bigger risk would be, if we did see labor markets loosening a lot more than anybody expected. Look at the forecasts for unemployment. They're generally peaking at about sort of 4.5, 4.6%. That's still way below the decade average for unemployment, which is about 5.5%. So I think if we see labor markets holding as tight as what most economists expect, and the RBA forecasts line up with that, then I think we'll see arrears relatively contained, maybe higher in some markets. You would have seen that previous set of graphs I showed. Generally, you do see higher arrears for, say, high LVR or high LTI or high DTI styles of lending. But each of those components of lending have been really contained. You're looking at, say, high debt to income ratio or high loan to income ratio being, say, more than 6 times. That's sort of 3 to 5% of all lending at the moment, around historical lows.
Okay. Let's turn our minds to the rental market, and this is one that I always find a bit of a contradiction to me, because on the one hand, we're seeing rents rise. Recently helped my son find a rental property and was blown away by the queues for what were, quite frankly, substandard properties for inspection. And then on the other hand, you drive around, particularly Sydney at night, and you see lots of vacant units and properties there. So interested in what you're seeing is happening in that market, Tim.
Yeah, Tony, the rental market is still pretty tight. I wouldn't say everywhere. There's markets like Hobart and Canberra where we have seen some downwards pressure on rents for a while there. They're generally balanced out or stabilized now, but there are 2 good examples of markets that have much more balanced supply demand to rental markets, at least. For different reasons, Canberra's had a lot more unit supply coming to the market, for example, whereas Hobart or Tassie has seen a reduction in population growth. It's been, at least interstate migration has been heavily negative and getting worse. So that's eased up rental pressures, but most other markets are still seeing strong demand from migration, although that is easing off without really any rental supply response. So if we look at some of those trends, the dynamic in overseas migration is really clear, right? You can see this downwards trajectory in net overseas migration, and that's going to continue till it gets roughly to around normal levels. Sure, it's still high on the December numbers, but you can see it's clearly peaked back in Q1 of 2023. And as you can see on the numbers off to the right, the vast majority of these migrants are temporary, right? Which is why they're generally feeding into net overseas migration. The reason that those 2 numbers, by the way, don't add up to 100% is just simply because we have a negative number in Aussies that are leaving the country. Okay, so even permanent migrants, not really too far off normal levels as well. So most of this migration trend is very much being driven by temporary migrants who have a rental requirement rather than housing requirement. And with that in mind, we're definitely seeing an easing in the upwards pressure on unit rents in particular. So absolutely, rents are still rising, but just not as quickly as what they were previously. So you can see house rents are reaccelerating a little bit. That reacceleration in house rent is mostly being driven by the outer fringe markets and also by some of the regional markets as well. I think we'd put that down to, say, rental affordability becoming more challenging alongside the peak in overseas migration, particularly from students, that's probably delivering a slowdown in unit rental growth. And just to reiterate that point of rental affordability, this graph here just highlights that renters are now dedicating a record amount of their incomes towards servicing their debt. And it's really rare to see renters dedicating more than 30% of their gross income to paying rent. Once you get above that level, renters kind of hit an affordability ceiling. They don't have a great deal of elasticity in how much they're able to pay. So a typical renter, they couldn't approach a bank, they couldn't come to Bluestone and get some more money or some credit to pay more rent. You can for buying a home, that's much more elasticity. So I think with renters approaching or probably at an affordability ceiling, we probably will start to see a lot more restructuring in rental demand. And by that, I mean larger rental households, group households reforming, maybe some signs of multi-generational rental households, younger folks staying at home with mum and dad longer, that type of thing. So be very surprised, even with vacancy rates holding generally quite low, I'd be really surprised if we continue to see rents rising as quickly as what they have, simply due to affordability pressures, but ultimately also a slowdown in migration rates. But the flip side here is we are generally seeing rents rising faster than values, although it's different from region to region, which means yields have recovered. So the typical yield across the capital cities at about 3.6% gross. That's a little bit higher than pre-COVID times. Regional markets a little bit lower than pre-COVID times. But look at that yield trajectory for Melbourne. As I mentioned a bit earlier on, Melbourne is really the number one city that's driving a yield recovery. So when you have better affordability, higher gross rental yields, I think in a few years' time, that will really start to become quite an attractive element of the Melbourne marketplace, despite the high taxation environment. So it's bucking the trend a little bit. You can see markets like Perth, Brisbane, Adelaide, where value growth is really strong. That's where yields are compressing, simply because values are rising so much more than rents. But they're compressing from a pretty high base, particularly in markets like Perth, where you've still got a 4.5% gross yield compared to, say, a Sydney at 3.1%. Remember, you can probably take at least a percentage point off these gross numbers to net it out. So we're still seeing net yields in markets like Sydney and Melbourne quite low when you compare it back to, say, mortgage rates above 6%.
Another related question from the participants here is there's a supply issue on rentals. How much of a factor does we call the Airbnb factor play in this?
Yeah, there's been a couple of studies on this. The University of Queensland actually did a really good one about a year or so ago. And their outcome on that, they actually didn't release the report. It was done for the government, but they did have a media release out on it. And their findings were that the impact of, say, short-term rentals or Airbnb was quite specific to areas like around inner city, Brisbane, some of the regional tourism hotspots as well, Sunshine Coast, Gold Coast, as you'd expect. But more broadly, the impact didn't seem to be significant. And you can probably also see, like through the pandemic, a lot of short-term rentals logically would have converted to long-term rentals simply because there wasn't a lot of demand for short-term rentals through the pandemic. And they're now probably converting back to short-term rentals, especially in some markets where we're seeing tenancy reform fairly broad spread across the country. So it's arguable that a lot of investors would be looking towards, say, short-term rental markets where they don't have the same level of, I suppose, your regulatory intervention around tenancy rights and so forth in the short-term rental market. So they can circumnavigate some of those rules around, say, for example, having pets or minimum requirements for tenants and so forth. Don't get me wrong. I think a lot of the tenancy reform is very necessary, and tenants certainly probably needed to see an improvement in tenancy rights. But for investors and landlords, you'd have to argue that is somewhat of a disincentive. So yeah, to answer your question more succinctly, Tony, I think Airbnb probably does have an impact in certain areas where short-term rentals are more popular, but more broadly, it's probably more around the fringe or the margins that we're seeing a significant impact to the rental supply.
So just sticking to that supply theme, I think governments all around the country have set themselves really ambitious new dwelling targets. And so probably two questions, one from me, just how they're tracking against that. And then one from participants is, part of that problem is people getting hands on greenfield land. And is the government, do you see the government, really opening up some of that stuff moving forward?
Yeah, so just a I guess a refresher on the government's targets for new supply. So you might remember the Housing Accord a couple of years ago. The federal government came out of that with a target of 1 million well-located homes in 5 years, and then 6 months or so later, they upped it to 1.2 million well-located homes in 5 years. And that 5-year time frame kicks off from July this year. So we're pretty close to the starting date. It is going to be a real challenge. And I think for anybody in corporate worlds, having a stretch target is something that's pretty ingrained. So I'd be the first to say this is great to see. It's good to see the federal government having an ambitious, highly aspirational target for delivering supply to the marketplace, but it's going to be really hard to get there. You can see historically, we've never built 1.2 million homes over a rolling 5-year period. The closest we got was the 5 years ending December 2019, when Australia built just over 1 million homes. And that was a period that was characterized by a real significant amount of high density dwellings coming into the market, particularly in Sydney and Melbourne. It was also a period that had very high levels of overseas capital coming into the country as well, something that seems to be a bit on the nose for whatever reason at the moment. The other reason this is going to be quite a challenge is this 1.2 million target is going to be moving from less than a standing start. And what I mean by that is you can see the dwelling approvals graph off to the right here. Approvals, the earliest phase of the supply pipeline, are way below average. We're seeing around about 13,000 dwelling approvals month on month at the moment. To reach the 1.2 million target, you need to see 20,000 approvals a month. And the longer you miss that, obviously, the more the market needs to catch up. So I think for these reasons, it's going to be quite a challenge. And of course, you've also got the added complexity of construction costs. Even though we're seeing construction costs rising at a fairly normal pace now, they're rising at about 0.8% quarter on quarter. That's a bit less than average. This period of just dramatic construction cost increases, which means construction costs have increased by about 30% over the past couple of years, it means that margin pressures are still there. Profitability for builders and developers is something that's quite hard to come by. So it's going to be still quite a challenge for builders and developers to get stock into the marketplace that they can deliver with a reasonable profit margin. So I think you'll start to see a lot more, policy discussion around how do we get this 1.2 million target much more achievable. In my view, it probably has to be accompanied by more stimulus for the construction sector or the residential building sector, maybe in the form of things like supporting developers with their infrastructure costs. For some developers, that could be upwards of, say, 20 to 30% of the cost to build a home would be, things like sewage connections and so forth. We've already seen some examples of that where either developers are getting offered low interest loans for infrastructure costs, or even some of those costs being covered for strategic projects. And I think also seeing a further boost to, say, social and community housing funding as well, which seems to be the government's way of outsourcing public housing to the market. I think it's a given we'll see more stimulus in this sector aimed at trying to achieve some of these targets. And the reality is, eventually, there will be a supply response. We will see more supply coming into the market. And that's probably the time when we'll see the demand side pressures coming down, supply starting to improve, and we'll probably see the pendulum shift. And that's where we'll see housing prices stabilize, if not even some downwards pressure in housing prices once we do start to see a more material supply response shining through. Forecasts for new dwelling supply from the RBA and dwelling investment really start to pick up from the middle of next year. So I think the reality is we still have another 12 to 18 months before we start to see any real supply coming into the marketplace. And of course, it's taking longer to deliver property to the marketplace as well. So probably still at least 2 years away before we actually see inhabitable stock coming to the market in any material sense.
So with cost of living, supply issues, demand picking up, has the Reserve Bank's monetary policy worked, or should we have taken a different approach?
Well, yeah, I think it has worked. Remember the RBA obviously have an inflation mandate, but also they're looking to keep labour markets as at full. And they're walking this very narrow path of trying to ensure that the economy still sees some growth and they don't push labour markets into too weak an area. And they've got the challenge of bringing non-discretionary inflation down at a time when fiscal policy arguably is not helping as much as what it could when you have a lot of rebates and so forth that potentially could fuel consumption. We've also seen the RBA becoming, I think, maybe reading between the lines a little bit, maybe a little bit cautious around the impact of higher housing prices as well. There was a statement in the last, following the June board meeting, the RBA did mention that higher housing prices are an uncertainty in the sense that it could be fueling consumption down the track, essentially alluding to a renewal of the wealth effect. So I think that's probably a cautionary note as well. But of course, monetary policy does work a little bit differently, a bit more quickly or effectively here in Australia, because we do still have the majority of borrowers are on floating or fixed for floating or variable mortgage rates. So I think that helps to explain why we haven't seen as much of a lift in the cash rate as we have seen in, say, New Zealand, or for that matter, in the US or the UK. But it doesn't mean that interest rates are going to be coming down anytime soon. It does seem to be the consensus that most would expect that interest rates probably won't come down until sometime in the first half of next year. If you look at the big four banks, their economic teams, 3 of them still think we'll see a cut in November, but clearly in their commentary, it's a skewed risk to the downside of rate cuts being later. ANZ has broken ranks, of course, and thinks we'll see the first rate cut in February, but financial markets are still around sort of April, May, June. So yeah, I think it just speaks to the uncertainty around the trajectory of inflation and when we'll start to see rate cuts. But I think the good news is that most would agree that the next movement is going to be downwards. Pretty unlikely we'll see another rate hike unless the June quarter inflation number comes in again above 1%. We'll see that on July 31st. I think inflation comes out ahead of the August board meeting.
And just while on government policy, a question from participant. Recently, we've seen government announce that they're looking to build more homes for essential service workers. What sort of impact in the areas where they build those do you see eventuating on existing property prices?
Yeah, well, it is a supply response, but again, even with more funding for essential service workers or social and community housing would be in the same basket. I don't think we're going to see a fairly rapid or immediate response happening here. The funding is one thing; actually delivering the supply to the marketplace is completely another discussion. So we're still seeing builders and developers struggling with. Costs are one thing, but if you're getting the funding that helps to resolve that, but finding labor and skilled trades is also quite challenging, especially when you have a lot of big infrastructure projects or more broadly non-residential projects competing for the same types of labor and often the same materials as well. So there are still capacity constraints that are probably going to be a blocker here, at least for the next 12 months or so. But more broadly, once we do start to see the supply coming through, then yeah, absolutely. You'd have to think, well, first of all, that should help to alleviate some of the upside on rental pressures. A lot of these people are probably currently renting and looking for other alternatives. But also, if we're seeing this in the form of new supply coming into, say, the medium to high density market, then again, that's probably where we'll see the impact on the established market with being in competition with more supply. But yeah, I don't think it's going to be very, very quick. I don't think there's going to be, a sudden rush of supply coming to the marketplace across any sector, given some of the capacity constraints we're still seeing.
And another major piece of infrastructure going on in Sydney or New South Wales is the Western Sydney Airport. Impacts there. What's the crystal ball say?
Yeah, well, the immediate impact, of course, is this is a precinct or an area that's going to be extremely busy with building activity. Big infrastructure activity involves a lot of people that need housing as well, who are building it. And then longer term, of course, we're looking at satellite cities being established around Sydney. Badgerys Creek being a key one of them, along with, say, Parramatta CBD itself. So I think this is really changing the urban form of Sydney. Hopefully, you see that outer Western Sydney becoming much less reliant on people commuting back into the CBD itself, much stronger transport connections are certainly a clear positive. The long term, the productivity improvements from better transport infrastructure are clear. You'll probably find it is somewhat stimulatory in the immediate term as well as the long term as well. So I think initially it's all about the amount of people involved in building this infrastructure. They're generally going to be wanting to be close by and need housing to be accommodated in. But longer term, it's more about the productivity improvements and building up, a new hub that for Sydney, where you don't necessarily need to be commuting back into the inner city precincts or commuting into the city to go out to another spoke, if you will. So yeah, it's great to see. I think it's probably a long time coming.
And just finally, high density housing and lots of proposals of within 400 metres of rail stations, investing, governments really driving and investing. Is that going to impact? We've traditionally seen freehold properties grow quicker than units. Do you see a shift there?
Well, I think the town planning strategy of densifying around transport nodes, including train stations or busways, major arterial roads, to a lesser extent, is normal, right? As we grow in our population, there's got to be some densification, and you'd have to expect that governments at all levels are going to want to leverage the capital that's been invested into this type of infrastructure. So the densifying around those sort of transport nodes, I think, is something that is a necessity. How is that going to impact on the broader market? Well, arguably, if you have a detached home in some of these precincts that are densifying, it makes them more valuable because of the scarcity value of land, of course, but it probably does mean that we will see more density stock coming in, competing with the broader marketplace. We're already starting to see unit prices in many areas are rising at a faster rate than house prices now, because the gap between house and unit prices grew so substantially through the pandemic, because house values are rising at such a faster rate. But I think now that we have such an affordability challenge and first home buyers and investors are becoming more active, generally it's going to be very competitive from a price point perspective, which is probably going to divert more demand towards that medium to high density sector. Arguably, the better prospects for growth will still be long-term growth, will still be detached homes because of that scarcity value of land. But you'd also have to think that there's going to be a broader element or a greater element or greater proportion of housing demand that's looking towards the medium to high density sector because of its affordable price points and also because of arguably the strategic location, accessibility to transport is going to become very important, if not already.
Thanks for that, Tim. And as always, we've run out of time. We could keep going. But Tim, as always, absolute pleasure catching up, and always insightful. And thank you for sharing with the team, and thank you for your continued support of Bluestone.
Always a pleasure, Tony. I'll see you next time.
Thank you all for joining us, and we'll see you next time in a couple of months. Bye now.